In today's video, we're talking about what's happening in the market, are we headed for a crash, and what's going on with interest rates. Those topics and more next. Let's dive in. I've seen so many videos about the housing crash, when it's going to happen, different opinions, and here I am making another opinion video. But I'm going to back up what I'm saying, not to give you a roses view, but I want you to have a view that's a little bit more middle of the road. Comment down below and let me know what you think of the video. And while you're there, if you don't mind, do me a favor, smash the bell button so you get notified when I upload new videos, and please subscribe to the channel. It helps me out greatly. I would appreciate that. Anyway, post 2008, laws were put into place to prevent the issues happening again. So we're not having predatory lending practices. We're not giving subprime loans. If you remember back then and you were in the market, anybody with a pulse could get a loan that otherwise, under normal circumstances, they wouldn't have been approved for a loan. So we fast forward now to where we're at today. Housing prices are up, affordability is way down. And during COVID, or what we're going to call the unicorn years, people were paying a lot of money for houses. People were bidding 10, 15, 20, even more thousands over the ask price to win the bid, because the interest rates dropped so low, it allowed people who would have otherwise not been eligible into the market. So now we have more buyers and a low inventory, which causes prices to go up. Bidding wars happened. One of the biggest differences between the unicorn years and the previous crash is banks aren't lending 100%. Banks aren't lending 110%. Banks are lending on a normal level. Let's say you're doing a conventional loan and it's a 80-20. Banks were not lending over what the home was worth. And you have to go through a lot to get a loan nowadays. No more unverified income loan anymore, things like that. And then what you had to do if you wanted to win the bid is you structured your deal differently. You had to come up with the additional cash to bid over so that you could win your offer. That's one of the reasons these prices drove up so high. That, coupled with low inventory, led us to where we are now. Let's start with talking about inventory so that we can set a baseline of where we are today, where we should be, and maybe where we were. Currently, we're at 3.3 months of inventory. So what's that mean to you? And what's normal? This varies a little bit, but a balanced market is 6 months of inventory, which means equal leverage on the buyer side and the seller side. When we go down to 3.3 months of inventory, that means there's a little bit more leverage on the seller side, meaning there's more buyers than there are homes for sale. So this is where we're at. Now, where were we? Where have we been? This has been something that people have been talking about for the last couple of years, to be honest with you. So let's take a look at this graph. Looking over to the left, from 1999 to about 2005, we ranged anywhere between 4.3 months of inventory to the max of 4.8 months of inventory. Now, if you look over to the right, you'll see currently we're at about 3.3 months of inventory, and this is nationally. Now, these numbers do change depending on the region and the area that you're in. You can see if we were to just draw a straight line across, we're a little bit below inventory, which is normal. So normal's right around that 4.8. We also spiked up to 10.4 in 2008. Remember, that was during the housing crash, so the inventory levels went way up. Are we going to get back there again? There were so many other reasons that we were there, like we've already discussed. I just don't foresee something like that happening again, for at least for those reasons that the 2008 crash took place. Why are we here in this inventory issue that we have? During the unicorn years, everybody remembers that basically the interest rates went down so low that it introduced a whole bunch of buyers that otherwise wouldn't have necessarily been able to afford homes. There were a lot less homes for sale, and there were a lot more buyers in the market. Now, fast forward to 2023, we're kind of still recovering from that. We also have what's called the lock-in rate. We'll touch on that in a little bit. And we'll talk about some of the other reasons that we are in somewhat of an inventory crisis. But you can see this isn't something super new. That's the point of this. We're at 3.3 now, but if you go back, pre-COVID, there were years there where we're right about that 4.5, 4.6, 4.7. Those Those are pretty much our average. So why? What's changed? One of the reasons is new construction. You can see here in this graph, for the last 14 years, we have been below average on new construction starts. And that's a 52-year average I'm talking about. Well, why is that? Basically, during the crash of 2008, the builders got stuck holding the bag, basically. They had too much inventory. They had homes that were priced too high. People started losing their homes, etc. So they're still feeling that. And then they weren't quite as bullish with making new homes and putting them onto the market. Another reason that we have some issues with inventory is people are staying in their homes a lot longer. So in a recent survey conducted by the National Association of Realtors from 1985 to about 2009, the average tenure in a home was 6.1 years. Fast forward to 2010 up to 2022, the average tenure is now 9.3 years, and I'd be willing to bet that might go up a little bit longer. We'll see how the data comes out here year to year once we close out 2023. So what's happening there is the turnover in the market has shifted. People are staying put a little bit longer before they turn that home over into another property, whether they're upgrading or downgrading. So I mentioned lock-in rate. That's another reason that we have some issues with inventory. What do we mean when you hear lock-in rate? People with lower interest rates typically aren't going to sell their house. That's what we mean. So take a look at this graph real quick to help with the illustration from FHFA. People with an interest rate at or below 3%, they're probably not going to sell. Think about it. Before COVID, our average interest rate was about 5.5, basically, depending on credit and what you were buying. But you can see they're probably not going to sell. If they're at 3 to 4%, at some point they're going to sell. You move up into the 5 and 6% range, people will sell because that was average. That was normal. That's nothing new. 6%, yes, they're going to sell. They're comparing apples to apples at this point. How many people actually have mortgages with 3% or less, 4% or less? So when I started to dig into this, I was actually surprised by this number that I found. According to Realtor.com, the new listing count of August each year, starting in 2023, we're right around 387,000. Going back to 2019, remember I talked about not counting the unicorn years, so that we're comparing normal to normal. That's our goal. In 2019, we were about 479,000 new listings each year. The total listing count for August each year. Now, this is where we're down significantly here in 2023. We're at about 1,099,000. Back in 2019, we were at 1,659,800. The active listing count for August 23, we were about 669,000. Compared to 2019, we were at 1,235,000. So you can see that we are extremely low on the listing and inventory rates that we have comparing month over month and year over year. How does the inventory really pertain to you? It's supply and demand. There's more consumers in the market today than there are homes for sale. So therefore, we're still into a seller's market. And as long as we have that effect going on, the likelihood that prices are going to come down are extremely low. So one of the reasons also is interest rates. Interest rates are through the roof right now, especially if you want a 2% interest like we had back in 2021, 22. Those days are probably gone. Interest rates have never been that low before, and the likelihood of that happening again is very, very slim. We don't want to see interest rates like that. We want to get back to a moderate interest rate for purchases across the board. And with these interest rates up so high, that's slowing the market down and helping balance everything back out across the board. So if interest rates are so high, how come people are still going to buy houses? Well, here's why. Homeowners in America are sitting on a tremendous amount of equity in their homes. So interest rates to people who have no mortgage and can sell their house and then buy a new house, they're not affected by interest rates because they're not taking out a loan. They're not taking money out of their own pocket. They don't have to save money per se. They're taking the equity out of their house that they've paid off over time and then putting that back into the market and purchasing a new home. Now, I know home affordability is completely different. But remember, people are going all over the place. If you're coming from maybe like the Northeast, some of the properties in some of the bigger cities are significantly more expensive than they are here in Tampa Bay area where I'm at here in Florida. So let's take a look at that real quick. 68.7% of homeowners have paid off their mortgage or have at least 50% equity in their homes. That number to me is staggering. It's a great thing, but it's staggering that many people have paid off their house. Another thing to point out here is notice that little piece of the pie that says 0.12% of homeowners have mortgaged homes with negative equity. This is going to lead me into my other question that I get a lot, which is, Bill, what about all the foreclosures? They're coming. That's going to drive the market down. We're crashing, and I'm going to hold off until that slew of foreclosures comes in. So let's look at some numbers on that so that we can make an informed decision on this. Foreclosures in the first 6 months of 2023. I'm talking about foreclosure filings, default notices, scheduled auctions, or bank repossessions. If we look over here to the right side of the graph, we're at about 186,000 foreclosures for the first 6 months of the year. 2022, we had about 165,000. 2021, we had 65,000. They went up significantly. So you may remember some articles coming out that were saying like foreclosures are up 60%, foreclosures are up 80%. I saw all kinds of crazy news come out when this number came out. If you remember though, in 2021, there was a moratorium on foreclosures. You weren't allowed to foreclose on somebody's house. We were in the midst of the pandemic. That's why I talk about when we're comparing years back, yes, it's important to look at the year previous to where we're at now. But because those unicorn years were so off the wall, we have to go back a little bit further to see what normal is and then kind of pick back up where we are and put all the pieces together. If you look back into 2019, we were at about 296,000 foreclosures. What we're starting to see is a decline. Remember the people who had a tremendous amount of equity in their homes? There was also the forbearance program, which saved a lot of people from losing their homes. These are good things. We don't want that foreclosure inventory back into the market again, and we don't want people to lose their homes. What happened is because of the massive amount of growth in equity over such a short period of time, I'm talking huge numbers over the past 3 to 5 years. Let's take a look at this real quick. These numbers again shocked me. The national average over 5 years was 57.3% of equity growth in homes. That's a ridiculous number. But what's normal for us? A normal market, taking some numbers from 1980 to 2022, the study from Freddie Mac showed that the 42-year average was 4.92%, which makes sense. Now, there were some lower years here where you see the red graph, everything dropped. And then if you look over to the right, you'll see here where in 2021, the number spiked through the roof, where we got most of our gains. If you look over to the last bar graph, you'll see we're kind of right on that average of 5%, 4.92%, closing out 2022. So that's what's really helped some individuals who were in a foreclosure situation where something drastic changed in their life and they just couldn't get caught up with their mortgage. Something tragic happened and they couldn't make their monthly payment anymore. Luckily, because of these equity gains, they were able to sell their house, have enough equity to pay off their debt and move on and avoid foreclosure. You can see that foreclosures are on a serious decline, which is great. According to Freddie Mac and Fannie Mae, from January 2022 to June of 2023, you can see in the graph here that everything is declining as far as serious delinquencies, which is 3 months or more delinquent on mortgage payments. That's a fantastic thing. We don't want foreclosures to happen. So if you're waiting on this massive wave of foreclosures to happen, or maybe you're at an event and somebody was talking about foreclosures and this is stupid, you shouldn't buy now because we just wait for the foreclosures. Well, here's the data. I decided to look into it because I wanted to see for myself and make sure I understood what I was talking about. And we are on a steep decline. So with all those conversations, it kind of got me thinking, Why is this still out there? We're seeing all this stuff in the news on YouTube. Obviously, people want, you to click and everything. That's fine. I understand that. I want you to follow me. Speaking of that, if you do like this kind of content, please smash that bell button and subscribe, and that way you get notified when I do new content. It helps me out, and I greatly appreciate it. So as I started to look into this data, I wanted to see where people were mindset-wise. And of course, there is some data out there because this is a hot topic. And it's an important one too for everybody. Everybody needs to make an informed decision on what's really, really happening here. So the Consumer Confidence Index, I've got the numbers from 2010 up to 2022. And in the polled homeowners, 37% believed that over the next 12 months, prices would go down. So coming into 2022, people believe that prices were going to actually come down. And you can see that that is not the case. Prices have been continually to rise at a more modest rate, which is, again, a good thing. And we're also starting to see that the consumer confidence level is getting much better. Going from January 37% down to July during the last poll was about 24% of Americans believe prices are going to go down. So this is a good thing. I don't know if it's going to happen. Nobody really does at the end of the day because nobody's a fortune teller. But what we're seeing in all the data and the stuff that I've shown you, the crash is not going to be here. You may see some data out there that says, but Bill, look, we had month over month inventory is down. Oh, look, the prices came down. Or if I'm going on, one of these forward-facing sites and looking at my home estimate and I see all this sales, price down, price, certain markets are going to be different, but looking at the average for the United States, we're right around 100 to 98% on list to sale value. Those numbers change market to market. So if those are some things that you're interested in, make sure you reach out to a real estate professional in your area and they can talk about your specific market and segment it down, because certain neighborhoods and certain areas, even here in the Tampa Bay area, do change. We have these little what we call micro markets. So if that's something that you're interested in, take a look. I'm giving this broad strokes because it leans towards more of the health of the real estate market. As a whole, I almost hate to even talk about predictions because they're so all over the place right now. But take this with a grain of salt, take it with what you will, use it to kind of make some of your own decisions and judgments. But the further out we get, the less we know on predictions. If you look at 2023, we're going to close the year at about 3.2% equity growth. 2024, I think everybody's on the same page. We're going to be a little bit lower, but we're still going to either at least be flat or at 2.17%. And then it's 2025, 3.24%. Again, these things get revised so much because we don't really know what's going to happen with interest rates. And I know there's been a lot of data out there that said the interest rates are going to come down end of the year, beginning of 2024. I just don't really see that as reality anymore. And a lot of people's bullish predictions for the end of the year, beginning of next year, have started to pull back a little bit more to modest predictions from these economists, which is a good thing, trying to set some expectations. But this is a very fluid thing happening right now because there's so many issues going on that are affecting the housing market. So how does this all tie up? If you need to buy a house, well, I'm not going to pay a 7% interest rate or an 8% interest rate, and I understand that. But the best time to get into the market is when people aren't in the market as heavy. So right now, we don't have a lot of people in the market. So if you can afford the additional mortgage payment in the short term, you could probably get a better deal right now because there's not as much competition. And right now, at least in my area, we've got a little bit more leverage with the sellers. Now remember, it's still a seller's market, but we're getting back towards a more balanced market to an extent. But we do have a little bit more leverage, particularly this time of year. Now, come the beginning of the year, this is just our area. We're going to start seeing an influx of people unless something dramatic changes, but that's just history for our area here in the Tampa Bay area. And we just, that's what happens every single year. So take that into consideration. If you're selling your house, like we talked about, a lot of people don't have a mortgage, so they're going to sell their house and they're going to come buy a house with cash. We're also starting to see an uptick of cash purchases again, and that's a national uptick because of that situation. People don't necessarily have to buy with a loan right now. If you want to make a plan, let's chat, figure out what works for you in your situation. And that's really what this boils down to. It's what's your situation and it's best for you. I hope that cleared things up a little bit. I appreciate you watching and stay until the end. If you have any questions, drop them down below and I'll be sure to answer them. I look forward to seeing you on the next video. Thanks. I'll see you soon.